my sense is that the U.S. is playing a very deliberate long game here, and that this is not going to go away anytime soon. This is one battle in a longer, in a longer period of trade tension. So I'm not assuming that there will be a deal that will put this whole thing behind us. And so, when you look at the 2019 earnings estimates, they're already drifting lower as they typically do. And I think there's some downside risk to that. Right now the street is looking at 10% growth. I think it could be more like 5 or 7%. And fortunately the PE ratio of the S&P already reflects a lot of uncertainty.
There's sometimes conflicting information that even comes from within members of the administration. I do think that the day-to-day, intraday volatility tied to some of these announcements, some of these tweets, is probably going to be with us for the next 90 days. So I don't expect the market to have a true sense of what's happening until we get closer to that deadline, if you even want to call it that.
I think I like the 3 Ts, the Trump trade truce. I think this is a 90-day pause, but it isn't really clear how we get past the real structural issues. So I think what we've done is as you said earlier, we've kicked the can down the road. Both sides can declare a win. I think from the Chinese perspective, this is an ideal outcome because some of the pressure short-term is reduced, but also they get to talk. And the Chinese love to talk. They love, they've been having dialogues with the U.S. for decades, and also during this 90-day period, in addition to negotiating with the U.S., the Chinese will be working every possible lever they can find to lobby, find ways to lobby down any sort of potential negative outcomes if there isn't a deal at the end of 90 days.
And it looks to me like the start of a muddle-through strategy on trade, kind of echoing what transpired in Europe with muddle-through a few years ago. So the markets love that. I saw some predictions over the weekend that the markets could open up 2%, 5%. This could be a 10% rally. In reality, I think this is a nice reaction, and I think the market is generally saying, hey, let's see what happens 4 weeks from now, 6 weeks from now, 8 weeks from now, because we could still have some real economic issues.
Well, I think what it really, in essence, does more than anything, and by kicking the can down the road, it just increases the levels of volatility that we should expect going forward. Seasonality as well as volatility. And so one of the things we've been telling our clients is that this is the type of market that you should at least look to places where you have earning stability, sectors like healthcare, like dividend-paying stocks, where you actually maybe get a little bit of stability rather than just from the ups and downs that some of the more cyclical companies might in fact face.
Who knows? The president did make this announcement, which I think is the biggest trade risk we have in the market over the next days, which is if he does withdraw from NAFTA, and if Congress does not pass USMCA, NAFTA Part 2, that could have a very significant impact on the economy in the near term.
Why? Doesn't it mean we just default to the regular NAFTA?
No, it means you default to pre-NAFTA.
Yeah. The key thing I'm going to keep my eye on now is crude. You had a rally on the apparent new agreement between Saudi Arabia and Russia. If crude rolls over and begins to sew up again, I think it's going to change the complexion of what we're looking at. And crude will be a factor in Powell's decision also. So, I think December hike is locked in.